Good morning, everyone, and welcome to the morning show with RoD. Very special guest today, David Dziekanski, CEO and CIO of Quantify Funds. And today he brings the green.
Yes.
So thank you for bringing the green market, David, and thank you for joining the show. For those out there that I know you've been interviewing. Everyone probably knows you here, but just in case they don't, would you like to do a brief introduction of who you are and where you came from and about Quantify Funds?
Please. Yeah. Thank you so much for having me on. Today is going to be an exciting day in the markets as we were talking pre-call, just with everything going on with the government shutdowns and 50-year mortgages and gifts to tariff gifts to market participants. So my name is David Dziekanski. I've been in the ETF industry for 22 years. I was a math, finance, and econ triple major and master's in quantitative finance. First started off in the asset management space, managing in an asset management group for about 6,000 internal financial advisors. We managed about $1.8 billion of ETF managed portfolios for them. I went from there and I was a partner and portfolio manager for Title Financial Group. We did that for about 11 years, and I love the family at Title. I wanted to break off and create my own ETF company in partnership with them. It's always been my dream to launch true hedge fund-like vehicles in the ETF wrapper. If you think about the ETF, it's really literally a form of tax fraud, right? There's no other vehicle in the world that has the tax benefits of the US wrapper, especially in the US, and that's not the case necessarily everywhere in the world. So I feel very fortunate we live in the country that has this amazing tax treatment that is available within the ETF wrapper. And it's really so amazing that it really leaves you in a situation where if you can put a strategy in an ETF, why wouldn't you put it in an ETF? And if you're not going to, someone else will. So it's really just like who can come up with really unique, interesting ideas in the ETF wrapper. And, one of the knocks on creating more complex strategies in the ETFs has been that financial advisors have short attention spans. If you can't explain it in a 10 to 15 second pitch, they're like, meh, I don't know. Like, this guy's taking me to golf, right? Like, what are you doing? But what I love about what's happened in the individual investor community with shows such as your show right here, Retired on Dividends, and others, is how in-depth you guys go. And that's allowed us to feel confident in launching a little bit more complex structures and closer towards what we like to call like true hedge funds in an ETF, which take a little bit of education to understand, but can be very, very powerful tools. So very long-winded answer, but very excited to be here on the reopening of the U.S. government. Is that what we're calling today? So
yeah, exactly. Happy reopen day. Happy tariff dividend day. Happy 50-year mortgage day. But so I believe you said number 4 employee of Title. Mm-hmm. When you were at Title, were these rules of the ETF lax yet, or were they still strict that you couldn't offer funds such as, the fund that you created or, obviously YieldMax funds? Was that still early on, or did they change the game where they kind of opened the doors for the ETFs to allow to do different things?
Yeah, all the rules that changed that really allowed what you're seeing happen today in the ETF world happened somewhere between 2019 and 2020. Okay. And really, they allowed you to do active in leverage, and then they defined how you were able to do active in leverage with derivatives. The 18F4 derivatives rule change, which really allowed all of this to take place. And the ironic part is they had no understanding that this is what it would lead to. Quite frankly, at that time, most of the strategies that are out here today, if you had asked a market maker in 2019 to make a market on these strategies, they'd be like, no way, we are not set up for it. But that's like the evolution of these industries. And honestly, it's a good showcase into how all like government law ends up taking place. They put something in place meaning something, and then it ends up meaning 10 other things because there's all these other ways to view it and act on it. And then technology evolves. In this case, the market makers and what they can handle becomes a lot more complex. What the street will offer, the swaps available, the futures. Like if you think about just the liquidity in Bitcoin futures and Bitcoin ETFs and Bitcoin options on ETFs and IBIT, It's just amazing how liquid these categories have gotten so quickly. So no, like in the early days, you couldn't do anything nearly as creative as this. And I don't think anyone really thought that this was where it was heading. But then the rules did change, and ETFs got more and more hedge fund like, right? Not necessarily because the rule changed, but even just because it was a similar time in popularity. If you look at like the ARK ETFs and Cathie Wood's, and what's so fascinating is ETFs can actually change the way markets move. One of the things that attracted me most to Tidal was one of Mike's underlying concepts of ETFs truly affect the way asset classes will trade once it's available in the asset class. His longstanding example was the gold ETF released in 2004. Gold miners before 2004 traded like a really good defensive or inflation hedge. And then all of a sudden the gold ETF came out and people were no longer needed to use Newmont mining as their inflation hedge. They could just buy GLD, right? So the mining companies lost a lot of their multiple, and also like for a long period stopped correlating with inflation as well as gold did, because their multiple compression was just coming down over time because they were no longer the premier hedge in the marketplace for gold related inflation. And now we saw that in the VIX world. Contango and backwardation totally changed in VIX markets the second there were VIX related ETPs out there. And now you're seeing it, for example, in categories even just like crypto treasury companies, right? Yeah. Well, your MNAVs will shift over time as crypto becomes available within those ecosystems. A lot of people use MetaPlanet or MicroStrategy as like a proxy for Bitcoin from the institutional world when they couldn't directly allocate to Bitcoin themselves.
So speaking of Bitcoin, speaking of gold, I'm guessing you're a fan of both, right? Yes. Hence BTGD. Yep. BTGD, try to say that like a million times fast. It's hard. But so let's talk about it. Obviously, I think you launched it October 15th, 24. Was it hard to get it approved when you first filed for it? Because obviously it's leverage, right? It's exposure. You're giving yourself full exposure of gold and Bitcoin, but under the same umbrella, right? So can you talk about was there any difficulty getting that approved, even with like the regulations a little more lax and in your favor?
Absolutely. There was definitely challenges. We tried to push the needle and try to innovate and try to bring real original thought and ideas to the ETF marketplace. You'll never see us just copy and tweak other issuers' products. That's just not in our DNA. And so while there have been some stacked products in the ETF space, doing so with cryptocurrencies was the absolute first one that's ever been done. So obviously the SEC had a ton of questions, and honestly, everyone discredits this. I think it's actually a great process. You have this generic 75-day listing standard. If all questions are answered in that 75-day period, then your product is live. So it really is a phenomenal offering that we have, and the availability to that for ETF issuers is so amazing. But it definitely was a struggle, right? So we actually issued as a leverage ETF that doesn't have a daily disclosure that were just intended for daily use. That doesn't exist in our prospectus. So we market this as a buy and hold leverage ETF, or leverage for the long run, because of this amazing stacked concept of eroding some of the path dependency, because some of the onus of rebalancing goes on us because we at least have things to rebalance between. And honestly, it's just kind of as simple as that, right? If you just take the S&P and you leverage it on top of itself, it never has anything to rebalance between. Leverage ETFs get a bad name. You can receive your 2x leverage target as long as you're doing daily rebalances to keep yourself on pace, because it's not a natural form of leverage. It just puts the onus on the allocator to rebalance 3 or 4 times a week, whereas we end up doing a lot of that rebalancing responsibility within the fund because there's so much correlation benefits between Bitcoin and gold. And so it makes it a much less path-dependent leverage ETF. And what we like to say is the whole return stack concept, actually, if you want to know its origin, it really came from PIMCO. PIMCO started it in the 90s, and they still have these funds. They have stock plus funds where they'll take the S&P 500 and stack what they believe to be a good bond actively managed strategy from PIMCO and layer it on top. And it's a good way to structurally get some leverage in your portfolio, enforcing leverage and diversification. I think people shy away from leverage, but leverage used intelligently could be very beneficial. It can actually reduce your volatility. And that's what we've seen here with this Bitcoin and gold pair, is that even though we have slightly more volatility than just Bitcoin, it's not the volatility of Bitcoin plus the volatility of gold. It's just a sliver more than just Bitcoin itself. And in that, because there's so much diversification benefits between these two, and in that added volatility, most of it's coming from the downside. So since we've launched, we have less than a 1-to-1 downside to IBIT, meaning if IBIT's down 10%, we're down less than 10%. When IBIT's up 10%, we're up more than 10%. Because of the leverage benefits have kicked in on the upside and the diversification benefits have kicked in on the downside.
I heard you say that in a prior interview. How does that happen? Is it rebalancing timing, or how are you able to?
Yeah, so there's no magic behind this one, especially with the first product. We wanted to come up with a product that was more systematic in nature. So we rebalance on drift. We rebalance on about a 3 to 5% drift. And it won't always be the case that we will have a better than 1-to-1 downside to IBIT. There will be times when both IBIT and gold or Bitcoin and gold are correlated together on the downside. But if you look at on our website, quantifyfunds.com, on the BTGD page, we have a paper titled The Case for Bitcoin and Gold. And if you look on the third page of that, we have a chart that shows how gold has performed during each 15% or greater Bitcoin drawdown. And that's where the magic holds up, is that gold just actually holds its correlation benefits to Bitcoin really well, even in the face of volatility of Bitcoin. So gold will range from -4 to +14% when Bitcoin has these 15% or greater drawdowns. And so it's just that this is a particular amazing pair where the correlation benefits hold even in the face of volatility. So many people talk about the benefits of correlation, but oftentimes the things that you are seeking diversification benefits from all trend to a correlation of 1 in the face of volatility. And so it's really nice to find those pairs that really hold their correlation benefits even when volatility spikes.
So for people who maybe aren't familiar with BTGD, can you briefly explain how you're able to have 100% exposure to gold and Bitcoin? Is it through swap agreements? Is it through another method?
Yeah, no, it's a great question. So we don't actually have to use margin on our account. So our account's never going to be margin called. We get our exposure and our leverage primarily through futures. Also, a little bit we'll start introducing through synthetic options as well. And we don't use swaps in this market. But really, in truth, you should consider all three. And we have the ability to do all three. And it really just depends on who has the most effective cost of leverage and the cheapest roll costs. I think what we're really starting to see in the last couple of years is that not all products are created equal. And some of it is the actual work that's being put into creating the product, and some of it's just the asset class itself. And so, a lot of these 2x leverage single stock ETFs that have had some massive erosion, oftentimes is coming from very expensive swap agreements, right? Okay. So especially in the swap markets, you have to be very careful about what are your rates that you're being charged, because those can change drastically throughout a bout of volatility significantly, and then the interest rates can be, at least for a period of time, a lot more expensive. So usually when in doubt, we prefer to do the futures or the options route. So in BTGD, you can consider a cost of financing right about a T-bill rate, so right around 4.25%.
Yeah, and I see. I'm going to pull up for those that may not be familiar. There's other funds, right?
Yep.
That looked at. I know you filed. There's actually several funds on the website. If you go to under ETFs,
yep,
pretty interesting tickers. I love it. Nutty. We got Musk. We got Bets, Lays, Zip, Aped, Spicy, Book, and Nuts again. Nuts and Nutty.
Yep. So these are 4 of these are live. Aped, Lays, Spicy, and Zip are currently live. Yep. We won't say that those are not trading tools. These are definitely more trading tools, especially because some of the pairs don't have as much correlation benefits between the two as Bitcoin and gold. But there's still ample diversification benefits between, for example, let's look at Lays. if you look at like AMD and NVIDIA, and oftentimes it's like the magnitude of movement there. So there's still better long-term holds than just like leveraging individual single stock ETFs, because at least you get some rebalancing done within the ETF. And I know that sounds so silly, but that is so important in reducing some of the volatility drag that you can experience in traditional leverage ETFs. So yeah, Lays has been one of our strongest performers. I think it's up over 600% since the tariff lows. But the concept there is we're trying to offer almost super concentrated, almost mega cap offerings within select themes, being in this case AI and cryptocurrency, within our 4 that are available, as well as driverless cars with Zip and Uber. But these haven't, honestly, quite frankly, been met with as much love and success as BTGD, and a little curious as to why. But sometimes you kind of have to just put out things in your brand and see what the marketplace resonates with the most. So I'm surprised Lays hasn't gotten a little more love, just because of how strongly it's performed. But honestly, the one that I think that we feel is the best buy and hold option is BTGD, while the others are phenomenal tools to have, but you still need to monitor them because they can be very volatile in your allocations.
Is there a date where these other ones are going to launch, or is that not yet determined?
We have some new ETFs on the way. What I would say is we have a whole new series of 2 other filings we've done that will launch about 4 ETFs from in December, ahead of any of these unlaunched ones. So the rest of these will be probably sometime in 2026.
Okay. Yeah, and I'll ask the community now. What 2 tickers would you guys be interested to see? Because it seems, is this kind of the road where Quantify Funds is going to stick to, or are they going to offer, like, are they going to venture out and do different things, or?
Yeah. So we have 2 new filings, as I mentioned to a second ago, and I kind of consider them 3 different categories of ETFs. I think those will give you a better understanding of where we're heading, at least in the short term. So I'll go through them in very, very brief detail. I can't go into significant detail, but I can just discuss very briefly what's written on the prospectus. Okay. So the first one is, we'll start with the income lineup. So we have 6 ETFs that are income stacks that stack U.S. equities, Bitcoin, gold, and treasuries in all combinations. We'll run a derivative income strategy on each leg of that. It'll use the same concept as BTGD, where we stack 200%. But for example, ISSB will be 100% of the S&P 500 with a option strategy, as well as 100% Bitcoin with an option strategy. So we'll have stocks in Bitcoin, stocks in gold, Bitcoin and gold, which honestly is what everyone has been asking for the most, is an income variation of BTGD. So we'll have an income version of BTGD where we'll do a cover call on both legs, the Bitcoin and gold, as well as treasuries, Bitcoin, treasuries, gold, and stocks and treasuries. So again, if you're going to have derivative income in your portfolio and use a little bit of leverage, you might as well do it in a intelligent structure that rebalances between each leg and take advantage of that diversification benefit. And this is, I think, much better for allocators in that space who don't necessarily want to have to always stock their portfolio, but want some, obviously, very good management in there and also some embedded leverage in there, but done in a thoughtful way that is rebalancing and harvesting some of the volatility and the randomness in the markets, and allowing them to treat it more like a buy and hold vehicle. So that's where we're partnering with a firm called Convexitas. Zed Francis, who I think he'll probably join us on the next show, but he was a portfolio manager and one of the original portfolio managers for SpiderRock, one of the most impressive options hedge fund companies in the country. They got sold to BlackRock, but we're trying to bring true institutional management into this space. You know, it seems like a lot of issuers will just launch like newer types of strategies in certain specific categories because they sound good. Like, oh, hey, now we're doing only 0 DTE and only intraday 0 DTE. And guess what? They did that at a time that like 0 DTE options outperformed 3-month cover call options over the last 4 months for a very rational reason. And, you know, they'll kind of sell it as a panacea of like, oh, this is the way, this is how your performance. Like, no, these are tools, right? Like there's no single trade that can be wrapped and put into an ETF that's going to beat the institutional world to a trade, right? And the only way you can beat the institutional world is if you're doing a true strategy in an ETF and not a trade. And I think that's what I'd love to delineate our next launch to be, is we're trying to launch true strategies, not things that you have to trade, but actual strategies that have good investment philosophies behind it. So that's our income stack lineup coming up. We have the next
All right, real
two
quick
are
on the income stack.
yeah, please.
Sorry. So you're basically gonna have 2 funds or more, maybe underneath the ETF with 100% exposure, and you're gonna trade options on that exposure.
Yeah, so we have a beta target or a delta target to 1 of each of the underlying assets.
Yeah.
So a beta target to 1 in the S&P and a beta target to 1 on, for example, Bitcoin or Bitcoin
Yeah.
and gold. And we have we can't go into too much detail about what the strategy will be, but what I will say is, as we were alluding to before, there's no one strategy that's a panacea. These are all good tools used in different markets.
Will it be a max of 2 though, or will it be 2 or more funds or you can't say?
So it will be, these will just be stacks of 2, but it'll be 200% total exposure, and they'll be on broader asset classes. So you can think like the S&P 500 and Bitcoin, or Bitcoin and gold, or gold and treasuries, or treasuries in the S&P 500. So these are more on the larger building blocks in your portfolio.
That's going to be nuts. That's actually pretty interesting.
Yeah, well, because it's same thing as BTGD. If you go to BTGD's page and you go to that case for Bitcoin and gold, and you look at the first page, you can look at risk reward charts, and you can see you can see gold. I'll try to do this on the chart using gold, 2 times gold, Bitcoin, 2 times Bitcoin, and then BTGD up here with just pretty much just a little bit more risk than just 1x Bitcoin. And it's not magic, it's just diversification, right? And so if you're going to do leverage, do it with some systematic diversification. Obviously, in the options world, you have to have a very intelligent team, because as we can see, like, hey, guess what? The last 6 months minus the last week, zero GTE did much better than longer dated calls. We had very little. It's much more focused on jump risk than volatility risk. We didn't have a lot of jump risk, meaning didn't have huge jumps in prices for like a multi-month period until pretty much this last week. And realized volatility was really, really low. And expected volatility in the future was really, really high. All these things led up to an example where zero GTE outperformed, quarterly call writers or monthly call writers or weekly call writers, and you see it in the flows from the individual investors. All of a sudden, they start trending towards those. But like the message we'd like to give out is, these are tools. There's reasons to use all of them in different situations. But there is no one panacea of a single structure that will do it. So I would say focus more on finding a manager who's actually putting in the right consideration to create an interesting product. And honestly, there's a lot of really good managers in the ETF space that are doing them, but like not all of them. And you need to still do your due diligence and see if they're actually trying to actually create good products, or what I like to say is retail candy. Like tastes really good, and then you wake up tomorrow and you're like, I really wish I didn't eat that. Right? That's not the experience we are trying to have here. We're trying to create institutional quality portfolios that we're going to be proud of in 5 to 10 years, and have thought of all the issues so that it can run seamlessly for a long, long time.
Now, I know you talked about the income, and there's another side. You probably want to talk about those other funds. But I had a question, because BTGD, to me, would be appealing as an options trader, right? To trade it. But when I looked it up on Thinkorswim yesterday, it showed like a 40% IV. Is it because it's maybe just too new to the options? It does have an options chain, and it looks like it's monthly expiration. But do you know why the volatility would be so low?
The IV will fluctuate from time to time. It's definitely been a little bit higher than that in the 52s in the last couple weeks. But like, you're kind of selling the benefit of this vehicle, right? The benefit of this vehicle is like, have you seen a 200% exposed vehicle with that kind of IV? So we're very proud that there's a growing options chain on BTGD, and we think that will continue to grow. But you're right, it's not going to be this maximum volatility vehicle, even though it's 200% exposure, because of the diversification benefits between the two. You're adding, it's basically return of Bitcoin, return of gold, minus cost of financing, but it's not risk of Bitcoin plus risk of gold. And that's the beauty of this trade, is that you're not just adding the two risks of the two underlyings because of how diversified they are. But if we did ever have a bout in IV spike, you will be the first person I reach out to, and I'll let you know. So.
Yeah, because it does automatically. That's in my mind. I'm like, ooh, this is a good one to trade. But hopefully, someday it'll hit up. 40 is not terrible, but I would expect it like 100.
Oh my gosh.
Yeah.
I don't know how you sleep trading options on 100 IV baskets all day long.
Oh yeah, we love trading options on leveraged funds over here. We're a bunch of degenerates. But
so we do have 2 more options ETFs coming out as well. I'd love to talk about those if you don't mind.
Okay, cool.
These are our first foray. What I would like to say is our like true complexity of a hedge fund in an ETF offering. So we will probably launch one of these, but we filed for 2 of them. We're calling them the MNAV Harvester series. One of them's ticker is YTSM. Yes, we chose the ticker Misty in reverse. We think we're fixing a lot of Misty's problems. And the other one is MNAV. So we'll start with YTSM. It's going to be a beta target of 1.5, and that's 150% beta target. And its basket is going to be a combination of, through options, of long Bitcoin and Bitcoin Treasury MNAV harvesting. And what that means is that when these MNAVs are significantly above 1, we can actually go short, bear call spreads and such on Bitcoin Treasury companies. And instead of owning them as a reference asset, we'll own Bitcoin as a reference asset. So we won't be exposed to the beta of those crypto treasury companies, but still harvesting the volatility on them. Or if an MNAV is below 1, we can actually go long those crypto treasury companies. And so this will be a strategy that actually evolves, that will have, with time, with the MNAVs, with the environments and the opportunity, that can take either side of any Bitcoin treasury company on long or short. And either way, won't actually own it as its reference asset. It always owns Bitcoin as its reference asset. So we think that'll leave
Bitcoin treasury company. Are we only talking about MSTR? Or are you talking about you could trade any of them?
Any of them, yeah. Now we'll market cap weight, so we'll obviously focus a lot on MicroStrategy because it's the largest one out there. But yeah, and there's going to be some smaller cap names that forget about the ETF for now. If you just look at the DAT space, there's some Bitcoin treasury companies that are trading at like 0.6, 0.7, right? MicroStrategy is trading at about 1.25. Like shorting the MicroStrategy, going long some of the crypto treasury companies that have like a 30-40% discount to their MNAV. It doesn't have to be MicroStrategy that would have to buy them out. Just anyone else. At some point, there's going to be a pool of Bitcoin on sale, and someone's going to be like, "I'm going to buy that." Right? That's this. We live in a capitalistic world, and that's if you looked at the Chanos trade. I don't know if you saw over the weekend. He was talking about how he runs a hedge fund that was basically doing this trade where they were short MicroStrategy and long Bitcoin for like a 9-month period. He closed out of it. He said he still thinks their MNAV deserves to be 1 or lower, but he doesn't want to deal with like being nimble and doing all the trades. And but
now, can I pause right here? We keep saying MNAV. Would you be able to explain to the community what MNAV means?
Yeah, MNAV is multiple on NAV, so it's a comparison to a company's market cap based on their stock price and outstanding shares relative to their pool of assets. So in this case, crypto holdings and cash. Yeah. And so it's what is their multiple relative to their actual value as a holdings company. When we saw Bitcoin heading towards 108 last year in December, MicroStrategy was touching a 3 MNAV, meaning it was 3 times the value of its pile of Bitcoin. Today, it's at 1.25, right? Yeah. That's been a painful trade. But if we had been around, we would have been able to go long or short on either side of any crypto treasury company. Like, there's value to be had in that. And the question is, like, do you guys want ETFs that are like, these are trading tools or these are solutions, right? The trading tools I like to call like sharp knives. Like, they're great, but they're really sharp. And you need to always keep an eye on them and manage them yourselves. Whereas we're trying to err in the side of more solutions, which, quite frankly, say a 1.5x Bitcoin and Bitcoin treasury company MNAV harvester 10 times. It's not the easiest name in the world. But to really do a real strategy in an ETF one takes a lot of time, a lot of talent, bringing Convexitas in. We're still working with Tidal on the execution. we wanted to bring in a fresh options team with Convexitas to do this. And, we're very proud of it, but like, it's going to be an adoption curve of figuring out, well, what is this? At first, it sounds interesting. It's literally Misty in reverse on the ticker. But there's a whole lot of actual thought and process gone into constructing these things. And we're going to be very proud of them once they come to marketplace. So.
Yeah, definitely interesting. Have to keep an eye out for that.
Yeah.
So MNAV, that's a required value that a public company, if it's relevant, has to provide on a daily basis.
No, MNAV didn't exist as a phrase a year ago. Like, MNAV just came up in the last year. So MNAV is just what the industry has used as the metric to value these companies relative to their crypto holdings. So they don't need to state it. Some of them do. You can go to Metaplanet's website and they'll show their MNAV every single day. Not all of them do, but
MicroStrategy does. I saw.
Yeah. So and if you so a lot of them do
can
now.
only choose to invest then in Bitcoin treasury companies that announce their MNAV, since it's part of.
No, we can calculate our own.
You can. Okay.
Yeah. Oh, absolutely. Yeah. No, like, our intention is to run this as if you would run this in a hedge fund format. You're not going to forget about the companies because they don't show you their data. Like, all this is like, they do announce every time they buy Bitcoin. They do have filings and all of that. So all that's public. You should be able to calculate how many Bitcoins they have. You should have an idea of how much cash they have in their balance sheet, and you should have an idea of what you should know exactly what their share price and shares outstanding are. And then, like, the math gets more fuzzy and difficult when you start talking about the corporate actions. Like, how much do you punish, a large cap Bitcoin treasury company that has a lot of debt obligations because of past preferreds? What does that mean to their MNAV? What does being the largest crypto treasury company in a country mean? Because you actually should probably get a premium for that, right? Like, a Saudi wealth fund would love to buy 3% of all outstanding Bitcoin by taking a company private. If you ask them if they decided they were trying to get from 0 to 3%, they would affect prices so drastically. But to buy a company in bankruptcy or just not bankruptcy, or just to buy a company, a public company, and take it private, that doesn't move the needle of the price of Bitcoin. So, like, there's inherent values, especially to the larger stacks. But you have to take into account their viability as a buyout option, the corporate actions that have been put in place. And so it's not a single formula that we'll be able to get, or not an easy formula to recreate. But it's one that we're very proud to give more detail on once we can.
Wow. That's going to be an actively managed fund, to say the least, right?
Yes, it will. Yeah. We do have one more lineup if you want, but yeah, sorry.
Sorry. I just want to let the community know, if you guys have a question for David, please type in the word question followed by your question, and then I'll pull it up on the screen. Sorry to interrupt.
No, please. So our last filing is not in the option space, but products I'm equally as interested about. We're trying to we're indexing 2x baskets of crypto. Forget about Melania coins or anything that actually definitely doesn't have any value, and it's kind of like, who's to say what has value and what doesn't. We're going to take some assurances and say, like, Melania coin probably doesn't have any value. But if you look at all ETFs or all cryptos that trade in ETFs and have futures traded on them, so that's our universe. One of them is 2x all cap crypto, so Bitcoin, Ethereum, Solana, XRP, and Cardano. The next one is 2x alt season crypto that removes your Bitcoin, and it's just Ethereum, Solana, XRP, and Cardano. And then the last one is 2x alt season, which removes Bitcoin and Ethereum, and you just have Solana, XRP, and Cardano. And the idea here is crypto beta over crypto alpha, right? Like, if you're tactically trading into one of these vehicles, yes, you might have your Bitcoin. Cool. You can use the alt season one that excludes Bitcoin and gives you our own version of an adjusted market cap weighted version of the rest of them. But I think so many people are always focused on alpha when you look at a new category like this. Oftentimes, like, the vast majority of your returns are just going to come from getting beta at the right time. So trying to index basically different variations of crypto baskets minus some of the mega caps that people may already have allocations to, so that when the time comes, if they do want to choose to get bullish, they don't have to make the choice how much, what allocation, what percentage. This is going to be very easy trading tools to use to give you that like 2x exposure on everything else in your portfolio that you don't already have.
So you said alts. Is there ever going to be alt coins?
I don't
Like
know. Well,
Shiba Inu, Fart coin.
I mean, there probably will be, but I don't know. I think excluding Bitcoin and Ethereum, which is probably over 80% of the market cap of crypto. So our alt filing is like the bottom 15 to 20% of the market cap of crypto. So that's, I think that's as a degen as we need to go right now. I don't know if we need to also subtract Solana from that as well. But, again, I think a lot of allocators who have adopted Bitcoin in the ETF wrapper, like have their Bitcoin, have maybe some Ethereum, but the idea is to provide trading tools that like they can just grab that beta. And I think oftentimes when there's volatility in the market, like going into volatility, knowing the positions you want to buy and just making the decision of like, do I buy this today or not, is so much more valuable. They always say like good stock pickers and managers, they have their wish list. Like, here are the companies I like, regardless of price. And like, if these were on sale, I wouldn't think twice. I would just buy, right?
Yeah.
And so it's good to have your wish list on that. These are good options and good tools to facilitate that.
All right, first question of the day for you, community question at least, which I was going to ask anyway. Do you have a target distribution rate for the income funds that you plan on launching?
Great question. Cannot announce that yet. What I would say is we're very cognizant of actually being able to generate the return within the fund that we're trying to distribute, right? And so I think some formula of the total return of the underlying asset class and ability to generate premiums beyond that. But in truth, like what we believe you guys are seeking is a vehicle that has growth and has a growth potential on the upside as well. So first and foremost is total return. Like the first sentence in our prospectus is like the number one objective is trying to maximize total return, and income is second. So there are a lot of really good brands out there that have single leg versions of our products that haven't had massive NAV erosions, that have healthy but not eye-dropping distributions. So for example, like, Neos does a really good job in the cover call space, we think, and has a very appropriate distribution rate and leaves an appropriate amount of beta on the upside. So I think you could look at like reasonable alternatives to what we're trying to launch in that space. And you could probably say, well, take this one and add that one and minus a small cost of financing. And that's probably the range we'll be in. We don't anticipate to do much in the 70, 80, 90, 100%, just because there's no way not to, you basically cap all your upside. So if you're capping your upside and you're exposed to the downside, that's like, oh, your market's going well, you're kind of here, market's down, oh, you reset, and you just kind of keep resetting down. Not only is that hard to justify as an investment, it's hard to allocate to, it's hard to have any expectation of what your return stream is going to be, because your managed distribution is going to keep going down in lockstep with those. So what I would say is, obviously, we're going to come to the table with a healthy and attractive distribution rate, especially because we get to do two legs on top of each other, right? So, if you're looking at a single leg version of a cover call ETF and maybe the S&P is paying, 10 to 15%, 18% tops on Qs, or Bitcoin's a little bit higher than that, you can start to add them together minus the cost of financing, and you can probably create your own reasonable expectation for our range.
Yeah. But you won't lock yourself down to a rate. It sounds like you'll just kind of pay.
Yeah.
Okay.
Yeah. We have a very unique approach to this that we're going to release that I think is going to make a whole lot of sense and be very logical and very welcomed, I think. But we can't release that yet. And what I would say is we're taking this very seriously. Like, we will own our own funds. We're investing these funds to not just to have a flash in the pan. We want this to be something that really has true staying power, 5, 10, 15, 20 years out. And you just can't over distribute in that case. You can't have a distribution rate that, in my opinion, matches the IV of an underlying asset and expect to not have to do reverse stock splits every 2 or 3 years, which is more of a process than a huge problem in the ETF space. But we want allocators leverage cover call ETFs. In my opinion, allocators leverage means, or anything that you will deem in the allocator's bucket is something that you should be able to hold for years to come and not worry about just the price endlessly eroding.
Okay. Real quick shout to Mig's Room. He just bought members, 20 random memberships. So I appreciate him. Thank you to Mig's.
Nice. Good morning.
And then a question from Parabolic. Will you be sharing, because some companies, they do share their intraday trades on a daily basis. Is this something you're going to entertain or not?
Yeah, I would say we intend to be as transparent as possible. So what I would say is it's our goal to get to that. If we were going to show intraday trades on day one or not, I'm not sure, but we will within short order after the launch. Like the ETF wrapper is full transparency. We want to give you guys full transparency on everything that happens in this. So we're rebuilding our website right now. It's just a question as to if we, it's always time and engineers and programmers and try. So I can say that we will do that eventually. I can't promise that on day one we'll have the intraday trade files as well, but our intention is to show everything. That's the beauty of the ETF wrapper. And honestly, what I'm so impressed with by all of you guys, like if you sat down on financial advisors trying to do due diligence on funds, it's like at such a basic level, it's not even funny. And the reason why I feel crazy enough to launch, like you heard the MNAV harvesters, like real hedge funds and an ETF, is because you guys are doing this. So we will definitely get you all of our information, so you can fully see what we're doing in our strategies.
Yeah, because that's probably what would happen if it could be a benefit, right? Because you'll have more content creators. It could be a benefit and maybe not a benefit, right?
You should be proud of what you do. You should be willing for all of it to open up and dissect it. I think one of the things that's harder for you guys to judge here too is like actually getting really good execution costs. Like if you're doing, if you have this strategy that's trading, I don't know, 100 days a year or more, 200 days a year, what is your actual execution costs on that? So there's a lot more detail that we want to put out. But what I would say is we're proud with every piece that we're building in this. And so we are going to be as transparent as possible. So if not on day one, in short order after that.
Cool. Yeah, hopefully the website upgrade's done at the same time, because I know when you automate things, when they change the website, it's hard to pull the data. But so is there any? So you have obviously the current funds with 100% on each, kind of a duo. Then you're gonna have the income funds, and then you mentioned some others. Is there anything else that you want to share that Quantify Funds has, coming down the road, or is there anything you want to ask the community maybe that they may, to get feedback on?
Yeah, please. First off, this is an amazing show, and thank you for having me on. So I'd say we actually have one other filing that was our first filing with ticker YieldDA. It's meant to be an absolute return-like vehicle that focuses in the closed-end fund space.
YieldDA?
Yeah, it's not out. But I've been a manager of a strategy in the closed-end fund space for over 10 years. You can actually go to our sister Twitter account. We don't yet have this website live, but we do have a Twitter account, and it's called Quantify Chaos. And so we are actually scraping the SEC website every 30 minutes. 13Fs are one thing. 13Fs are 4 times a year with 45-day lag. But we are scraping the SEC website every 30 minutes for 13 Gs and 13 Ds in the closed-end fund space. So we track all the big institutional managers who allocate to closed-end funds. And oftentimes, 13G and D basically means that if they get to over 5% ownership, they have to make it public, all of their trades, with like a 3 to 6 day lag. So it's just a lot more relevant information on these underlying holdings than a 13F filing is, which has a 45-day lag. And candidly, we didn't launch that strategy first because it was a little bit complex, and I was a little bit cautious of having our first strategy in the marketplace be like what I would like to call a trust me product, where you'd really have to get to know me and our team and see what we're doing first and then decide. And that's why we opted to go with the Bitcoin and gold one first. We tabled that one. But we've gotten more interest in that space as of late. So if you guys like closed-end funds and like the idea of that being wrapped into an ETF, you can do some pretty amazing things in that space. We can hedge the duration by hedging out treasury futures, hedge some of the beta through S&P 500 futures. And the one thing you cannot debate is when you're trading at like a 10 to 15% discount, return of capital is the greatest thing in the world when you're trading at a discount. It's absolutely the greatest thing in the world. And so I think a lot, honestly, the managed distribution ETF space, there's a lot of interesting opportunities in closed-end fund. It's a lot harder to get the data. We spend a lot of money on closed-end fund data to get it. And you might ask, why aren't the largest hedge funds in the world doing it? You could ask Cliff Asness. He'll tell you there's alpha in closed-end funds. There's just not capacity, right? The firms that have the teams that can do this, they just but the second we get to $1 billion, the alpha starts being eroded. And I'm like, there's a lot of money to be made in under $2 billion of assets in these strategies. So this is something that we're kicking around, potentially revamping. It would probably be a halfway through Q1 launch. But it's a very unique opportunity set to get income in a somewhat diversified fashion. And oftentimes what we've seen is basically we're stalking what the activists are doing on their ownership, because they likely have to get to 12, 15, 18% ownership to really have any chance on the activist side. The second they get to 5, we know about it. So you can see on Quantify Chaos all the historical charts. And you can kind of jump ahead of the activists, and then when the discount closes, you can get out of it before they do. Or half the times the managers of the closed-end funds, in response to the activists, are saying, okay, we're going to buy back shares and at a discount that's supremely accretive, or we're going to have massive distributions way above what we can generate, but at a discount that's really accretive as well. They had BlackRock had a healthcare technology fund that was distributing at one point, I think 14 to 18% at a discount. That's supremely valuable. And so I think, given the level of research you guys are doing in this space, I think some interest in closed-end fund might be unique and interesting for your community. So I'd love to hear from you guys. Email us at info@quantifyfunds.com if this is a strategy that resonates with you, that you think would complement what you're doing elsewhere. This is a way to derive income without the option side of it, although you could potentially do both. But there's a lot of value, especially when you see how quickly we're chasing some of these institutional managers on Quantify Chaos on Twitter. They buy 3 days later, they post 30 minutes later, it's on Twitter. It's kind of as fast as possible as the data can get to you guys. And the biggest player in that space is Saba. Saba has won Activist Hedge Fund Manager of the Year 2 years in a row. But sometimes allocating with him is not great, because he gets stuck in positions because he has to see through the activist event, even if the majority of the gains have already been realized. And being able to trade out of it, knowing his information, is actually very, very helpful. So
okay. Here's another question, which is a good one, from Brother AB. What do you think is the biggest opportunity or challenge that Quantify Funds faces in gaining market share? Obviously, there's a ton of competition in the ETF space now, coming from every direction. What's your biggest challenge, you think, of getting the word out?
Well, I think we crossed 100 million in under a year in BTGD, so I think that was a very good hurdle for our firm. We're exceptionally well funded by true ETF pros and just people who are super connectors in the ETF space. Mm-hmm. I'd say the biggest hurdle is, well, first off, it is a crowded space, but what you'll see is we're not doing Me Too products. So we're trying to bring true innovation. So we're first to the stacked income space, right? There's no one else doing 200% stacks to SV and gold, Bitcoin and gold. So we're not a copycat. We're trying to come up with original products that are not retail candy. And so I would say the biggest hurdle is education for us, because these are, stacking is called portable alpha. It's an institutional process that's been around for 30 years, but it's not widely known in the individual investor space. Or the MNAV harvesters are amazing vehicles, but you have to really get deep into the DATs and understand what MNAV is and what a premium or discount to one might mean for MNAVs. So really, it's the education barrier that I think we need to execute well on to get the right material out, so it's very clear what we're doing in our funds and there's no ambiguity. But also, I feel very confident about that as well, because of how amazing you guys did this. I was on Bloomberg TV in January, right? And they asked me 3 questions, maybe. And I got a total of maybe 200 seconds of talk time, right?
Yeah,
It's like, well, how is anyone supposed to learn anything about what we actually do in that, right? Here, we're on minute 52. It's not even 7 a.m. on a Monday morning. And
exactly.
so I have faith that because of like shows like this that are really willing to do it, like if you're creating something that's unique and of value, I believe that you guys will have interest in dissecting it, understanding it, and then deciding if you like it or not. But I believe that you guys will get over the education curve of slightly more difficult products because you have the knowledge base and the interest. And so that's probably our biggest hurdle, though, is like the more complex, the more hedge fund like a strategy is, the harder it is to sell it in 10 seconds.
Yeah, especially to the Bloomberg crowd. I think your crowd is more so maybe in the right, in the YouTube space. Bloomberg is probably, I'm thinking of 90-year-old men still watching it and happy with their 2% yield.
And it's like BTGD, right? Like we are actually seeing a lot more institutional adoption in BTGD now. It's like, oh, now it's at over a year. Now it's proven itself in its track record. Now across $100 million. Now they're starting to adopt. So I don't think it's good if you have a fund that's 4 years old and has no institutional adoption, right? That's like there's being innovative, and then there's just like having a product that like the institutional world doesn't think is good. But I don't think you need that institutional adoption in the first 12 to 18 months. But our intention is to build products that are of value, that the institutional world will be all over it. It just, they are slower to adopt.
And I did want to show you, because this is impressive. I think you launched at $20. Correct me if I'm wrong.
$20 exactly. Mm-hmm.
Yeah, the fund is now, well, pre-market, it's up. It's at $41.59. So again, as of this is probably the close on Friday, up 94%. So I'll just say congrats
Thank you.
on whooping ass with this fund, right? It's doing
and not a lot of volatility. That's relatively a pretty straight line, all things considered, given the amount of return. And that's the beauty of the stacking here. So, and actually, if you go to our website, we have a fact sheet. We'll show our return and then individually Bitcoin and gold on one graph. And I think that can be very helpful. Yeah, if you scroll down here, and it makes sense. You can kind of just see it visually. It just kind of adds the return of one line on top of the other with small drag of the cost of financing. But our cost of financing is essentially T-bills, and it's unlikely that you're going to get margin rates as an individual anywhere near the rates that we can get in the futures markets. And that's the concept we have. Some leverage ETFs that we said you have to be cautious of them having too high of an expense of margin, which not all swaps are bad, but some swaps can get very, very expensive on the margin side. But this is a much more effective cost of margin here.
That's a pretty chart, right? It's probably fun putting that one together. Now, speaking of Bitcoin, I always ask everyone that joins the morning show. It looks like it's hovering around 106. If you're comfortable, I'm going to ask if you want to give two predictions. What do you think for the price of Bitcoin by end of year? And what do you think for the price of Bitcoin in 5 years? For fun and entertainment, of course.
Oh gosh. For fun and entertainment purposes only, I think Bitcoin could very well get to the 135 to 150 range this year. I think there's a lot of things that have been holding it at bay. First, we saw the Genius Act and the JP Morgan stablecoin, which just meant that, the big institutions out there that had like a 0.5% to a 4% Bitcoin allocation, all of a sudden they woke up and said, okay, I can't be on zero on other coins. I think the solidification of the need for a layer 2 like Solana or Ethereum, between the government getting behind it and JP Morgan issuing a stablecoin, can't be ignored. And so I think a lot of the muted upside of Bitcoin we've seen over the last 4 months has been the institutional world just rounding out their portfolio. Also, candidly, all the drops in MNAVs that we've seen, right? This has just been a market of shaking out some of the excess euphoria in the markets. I think, what was it, like 3 Fridays ago, we had that big drop on Bitcoin on a Friday. And people talked about a lot of leverage getting wiped out. What we also saw was a lot of really micro cap coins get destroyed and not rebound now. And so anytime you have a multi-year rally in an asset, it drags along other assets that might not be of true caliber and quality. And so honestly, I think this has been really healthy, shaking out a lot of the tokens that have no actual practical application. And so I actually think this is just healthy in the form of a longer term bull market. You know, if you look at the deal we made with China and this and that, like the drop in geopolitical tensions, people are almost mad that Bitcoin is trading like gold right now. Like it's trading like a store of value. And when we have a deal with China and this and that, like there's and less geopolitical tensions, the store value might get hurt in the short run. Like that's not a bad thing for the case long term. I've said this to most of you guys have heard me say this already, so I'll keep it short, but it's a game of scarcity. You know, like markets day to day are noise, long term it's supply and demand. And there's less than 1% new supply of Bitcoin every year, less than 2% new supply of gold every year. And we just keep printing at no end. And we just announced this weekend that not only are there now 50-year resi mortgages, which doesn't save you a lot of money in your payments, by the way. If the 50-year is priced 50 bips above the 30-year, you save about 10% on your monthly mortgage payment, like which is not that significant at all. Which is not that, except you have a debt payment now for 50 years, right?
No.
And then we saw the potential tariff payouts where we don't know how it's going to work, who it's going to work to, but potentially handing $2,000 to individuals again. Candidly, it's more of a political thing. Trump's trying to reassure his base in the middle of the country that feels like they haven't really gotten as much benefit from his presidency thus far as some of the coastal elites. But it just goes to show you that, last year I launched this product and people were like, it sounds like you're saying there's no bear case. And I was like, there is. It's the Doge task force. Like that's the bear case. We clean up our balance sheet. But the concept of any elected official going in right now and saying, thank you for electing me, my constituents, to help you. I'm cutting all of your funding. Please reelect me in 2 years. Right? Like who's winning on that election message? It's just not really happening. And Lynn Alden, if you guys don't follow her, is an amazing economist. She's been using the phrase from Breaking Bad for quite some time to put into perspective the fiscal situation we find ourselves in. The quote from Breaking Bad is, "Nothing stops this train." We're at a deficit level. Our spending is such a high. I think our second highest category of spending as a country is on interest alone. It's going to be really hard to undo that. Let's hope we grow out of that, right? Let's hope we. Yeah. Doesn't mean the be all end all in the world's ending. We could have massive productivity growth from AI and other things that in theory could help us grow our way out of it, but that doesn't mean that our currency is not going to be debased in that process and devalued.
5 year, you got to do it. 5 year prediction.
Gosh, what I would say is instead of giving a 5 year prediction, I would say that I feel confident this will be $1 million asset. I can't tell you in what time frame, but it'll be in a time frame where its compounding will still be exceptionally eye opening on the upside from here. Whereas I think a lot of people are like, "Oh, I missed the Bitcoin. What are the other fart coin, this and that I can do to catch up?" Like, don't worry about that. Like, just crypto beta before crypto alpha. That's what I would say. Stop worrying about.
It'll happen before we pay off our 50-year mortgage. Right?
It'll definitely happen before we pay off our, maybe a couple times over. So.
Okay, that's good. Yeah. All right, we're being respectful of time. Obviously, we're getting close to about an hour. I'll say to the community, if you have any final questions, now's the time. But if not, one thing I wanted to ask the community, I did ask them earlier, what type, maybe something for David, what type of funds would you guys be interested in? Or, the combination fund, 100% exposure of two different funds, what basket would be of interest? I guess the sky's the limit. You could pretty much do anything, right?
I mean, ideally things that have some level of diversification and then some level of commonality on investment theme, either commonality or exact opposite, like but please, we're open to all ideas. info@quantifyfunds.com. We'd love to hear from you directly. We're trying to build things that you guys want. So this is exactly what we want to hear.
Okay. So I'm going to do some closeout comments real quick, but in the meantime, think of a keyword. I don't know if you're familiar with my channel, but I do a keyword at the end of each video that everyone has to type in. So as always, this is not financial advice. I am not a financial advisor, and this video is for fun and entertainment. So hopefully you had fun. Hopefully you were entertained. If not, we'll try again harder next time, right? And David, obviously, thank you for getting up at the crack of dawn. I appreciate it. But this is the only time I could pretty much do interviews or sometimes late at night. But thank you very much for spending the time with us today. We appreciate you, and your fund is very impressive, and we look forward to your income funds in the future. They do seem very impressive. So hopefully we can have you back on once they launch, talk more about them. But that being said, for the people who made it this far in the video, they have to prove it by typing in a keyword. So if they made it this far in the video and they want to prove it, do you have a keyword for them that they have to type in?
Yeah, debasement.
Debasement?
Yeah, I think that's the word of the day today.
The word of the day is all right. So if you made it this far in the video and you want to prove it, whether you're on X or YouTube, it looks like we have about 459 at the moment combined. You got to type in debasement. And obviously, go check out Quantify Funds. I did pin it to the top of the comments of the live chat. I'll pin it to the top of the comments of the video. And if you have any questions, I believe there's a way to contact Quantify Funds through the website. Please. Any final words, David?
I really appreciate being on the show. I'm a huge fan, and I was excited for this day. And I think it was a very good first foray. So appreciate being a guest here. Thank you very much.
Yeah, I'm sorry it took so long. I know we were scheduled. You're going to be like the second guest originally, and then things happen on both of our sides. But here we are. We made it. Right.
It's better this way. So.
All right, hang on if you can. I'm just going to end the stream, and then we'll chat from there. Thank you all for watching live. Thank you all for watching after the fact. We shall talk to you later.